All right, question. An accounting firm is designing a relational database for fixed assets. The design includes an assets table with fields Asset ID, Description, Cost, Location ID. A locations table with fields Location ID, Address. Asset ID is unique within the assets table. Location ID links the two tables. Currently, employee names and payroll data are also stored in the assets table. Which statement best describes this database design? All right, let's break this down. Option A says Asset ID is a foreign key in the assets table and Location ID is the primary key in both tables. Nope. Asset ID is unique in assets, which makes it the primary key. Calling it a foreign key is like saying Beyoncé is just a backup singer. Technically possible in another universe, but not here. Option B says Asset ID is the primary key in assets, Location ID is both a foreign key in assets and a primary key in locations, and employee data should be separated through normalization. Yes, this nails it.
Asset ID uniquely identifies each asset. Location ID connects assets to locations, and payroll data has no business hanging out in the assets table. That belongs in its own employee or payroll table. This one's correct. Option C says Asset ID and Location ID are both foreign keys and normalization isn't necessary. That's a double whammy of wrong. Normalization is necessary. If you don't normalize, you get redundant and inconsistent data. It's like writing your address on every single pencil you own. When you move, good luck updating all those pencils. Option D says the address should be stored in the assets table to avoid joins. No way. Joins aren't bad. They're the whole point of a relational database. If you cram the address into the assets table, you'll repeat it for every single asset in that location.
That's messy, redundant, and makes updating harder. So the best description is option B. Now let's zoom out to the exam task, explaining the components of a relational database. A table is like a spreadsheet: assets, locations, payroll. Each table should stick to one theme. A record is a row: one laptop in assets, one office in locations. A field is a column: asset ID, cost, address. Fields describe each record. Transforming data attributes means storing them in consistent, efficient formats. Using a location ID instead of repeating the entire street address 100 times is a classic example. A primary key uniquely identifies each record, like a student ID, one per student, no duplicates. A foreign key links tables together. Location ID connects each asset to its location. And normalization is about separating data into proper tables so each table does one job well. Assets table holds assets, payroll table holds payroll. Mix them together and you'll have unreliable reports and one very cranky auditor. So the moral of the story? Primary keys are like passports, unique to you. Foreign keys are like airline tickets. They link you to a destination. And normalization? That's just cleaning up your junk drawer so you don't pull out a fork when you were looking for a pen. And on exam day, if you see avoid joins by putting everything in one table, treat it like the candy bowl at your dentist's office. It's a trap. Next question. A company collects the following information about employees: department, audit, tax, advisory, performance rating, excellent, good, average, poor, annual salary in dollars, hours worked per week. Which classification is most accurate? Option A, department equals nominal, rating equals ordinal, salary equals interval, hours equals ratio. Almost, but not quite. Salary isn't interval. Interval has no true zero. Think Fahrenheit. Salary has a very real zero. $0 means broke, so it's ratio, not interval. Option B, department equals ordinal, rating equals nominal, salary, ratio, hours, interval. Backwards on the first two. Departments are just labels, nominal. Ratings have rank, ordinal. And hours? 0 hours means no work. That's ratio, not interval. Option C, department equals nominal, rating equals ordinal, salary equals ratio, hours equals ratio. Yes, this nails it. Nominal, department equals labels, no ranking. Ordinal, performance rating equals ranked, uneven spacing. Ratio, salary equal intervals and a real zero. Ratio, hours, measurable with a true zero. 40 is truly twice 20. Option D, department equals nominal, rating ordinal, salary continuous, hours discrete. Mixing frameworks. Continuous versus discrete is useful, but the question is testing nominal ordinal interval ratio. Salary and hours may be continuous, but we still need the ratio label here. Correct answer, option C. Quick recap. Nominal, name tags at a party. Audit, tax, advisory. Ordinal, the coffee line. Excellent, good, average, poor. Ordered, but the gaps aren't equal. Interval, temperature in Fahrenheit. 0 degrees doesn't mean no heat. Ratio, salary and hours. 0 really means 0, and twice as much makes sense. In one breath, labels, ranks, equal steps with a true 0. When you design audit data analytics, nominal, group and compare by category. Ordinal, sort and segment by rank. Interval/ratio, run means, variances, ratios, regressions. Continuous versus discrete, pick appropriate tests and visualizations. Misclassify the scale and your analytics can turn into statistical soup. All right, next question. An auditor is planning to test sales cutoff and requests data from the client's IT department. Which request best ensures the data is suitable for audit procedures? All right, let's work through the options. Option A says ask for a PDF report of sales invoices for December and January. Nope, a PDF is like a photograph of the data. Looks nice, but you can't sort, filter, or test it effectively. It's audit window dressing, not usable raw data. Option B says request a flat file, like a CSV, with fields such as invoice ID, customer ID, date, product, quantity, and amount extracted directly from the subledger or ERP. Bingo! This is exactly what we want. Structured, complete, and machine-readable data straight from the source system. That's the gold standard for audit procedures. Option C says ask for an Excel file that summarizes total monthly sales by customer. Too summarized. Cutoff testing needs transaction-level detail. Dates, invoice IDs, amounts. A summary is like a highlight reel. You can't tell if the ref made a bad call. Option D says ask management to provide screenshots of several invoices. That's anecdotal evidence. Screenshots are fine if you're on Instagram, but not for audit testing. We need full populations, not cherry-picked samples. So the best request here is option B. Now, let's connect this to the exam task, determining attribute structures, format, and sources of data when making a data extraction request. When you request audit data, 3 things matter. Attribute structures. You need the right fields for your testing objective. For sales cutoff, that means invoice date, posting date, product, quantity, and amount. Without dates, you can't tell if sales were recorded in the right period. Without amounts, you can't reconcile totals. Think of attributes as the ingredients list. You need the right ones to cook the dish. Format. Machine readable is key. Flat files like CSV or TXT are best. PDFs and screenshots are basically data handcuffed to a chair. You can look, but you can't make them walk. Summaries in Excel are okay for analytics at a high level, but not for cutoff testing. Source of data? Always go back to the original system of record, the ERP or subledger. Pulling from management's personal Excel files is risky because you don't know what they adjusted. Extraction from the system ensures completeness and integrity. So, in practice, if you're testing cutoff, you want transaction-level data with all relevant attributes. Ask for it in a structured, machine-readable format like CSV. Make sure it's extracted directly from the system of record, not a management-rated report. That's how you make sure the data you test is reliable. And remember, if you ask for screenshots, summaries, or PDFs, you're basically saying, please give me evidence I can't actually audit. That's like a doctor diagnosing you based on your Instagram profile picture. Looks fine on the surface, but not exactly thorough. Next question. An auditor receives a raw data extract of sales transactions in CSV format to test revenue recognition. The file contains blank customer IDs, duplicate invoice numbers, and inconsistent date formats. Which is the most appropriate transformation before beginning audit procedures? Let's break it down. Option A says, standardize date fields, remove duplicate records, and investigate missing customer IDs to ensure completeness and accuracy of the dataset. Yes, that's exactly what we mean by proper data transformation, cleaning the data so that it's reliable for testing. If you don't do this, you'll be auditing garbage data, and garbage in always equals garbage out. Option B says, convert the CSV file into a PDF report and compare totals to the trial balance. No way. Converting to PDF is like locking the data in a glass case. Looks official, but now you can't manipulate it. We need raw, usable data, not a pretty report. Option C says delete all records with missing data to simplify analysis. That's dangerous. If you delete blank customer IDs without investigating, you might erase evidence of control failures. That's like throwing out the alarm because it made a noise. Option D says sort the data by invoice number to make testing more efficient. Sorting is fine for convenience, but it doesn't fix the underlying issues. It's like cleaning your desk by shoving everything into one drawer. Looks neat, but the mess is still there. So the best answer is option A. Now, let's tie this to the exam task, determining methods to transform data to complete planned procedures. When we talk about transforming data, auditors often use the terms prepare, clean, or scrub. What does that mean? 1. Standardizing fields. Dates, currencies, product codes, they need to be in consistent formats. If half your invoices say 01/02/25 and you can't tell if that's January 2nd or February 1st, you're in trouble. 2. Deduplicating records. Duplicate invoice numbers can inflate revenue if not cleaned. Duplication ensures accuracy. 3. Investigating missing values. Missing customer IDs or amounts aren't just annoyances. They may point to breakdowns in input controls or master data. Investigate before you drop anything. 4. Other transformations. Sometimes you might reformat numeric fields, strip out extra characters, or join multiple files together. The point is to make the dataset reliable, consistent, and complete. Why does this matter? Because auditors can't just grab a messy CSV and jump into testing. If we don't transform the data, our results are meaningless. It's like running a marathon in flip-flops. You're technically running, but it won't end well. So remember, clean, standardize, investigate. That's how you transform raw data into audit-ready evidence. Moving to next question. An auditor uses data analytics software to examine revenue transactions and produces a visualization showing a spike in sales recorded on the last 2 days of the year. All right, here's how I'd think it through. Option A says document the spike as a normal year-end fluctuation since identified through reliable software. Not so fast. Just because software spit out a graph doesn't mean we can assume the spike is normal. Software shows patterns. It doesn't tell us if they're justified. That's our job. Option B says investigate the unusual trend by testing supporting documents for those transactions to determine if revenue was recognized appropriately. Yes, this is the right response. The visualization points us to a risk area, and we follow up by digging into invoices, shipping documents, or contracts to see if the sales were actually earned. This is what professional skepticism looks like in practice. Option C says conclude that the spike is evidence of management bias and propose an immediate adjustment to revenue. That's way too extreme. You don't jump from spike detected to management cooked the books. That's like calling the fire department because your popcorn burned in the microwave. Investigate first. Option D says ignore the visualization because analytic outputs are not considered sufficient audit evidence. Wrong again. True, a visualization alone isn't sufficient evidence, but it is a valid starting point for further procedures. Ignoring it would be like ignoring a puddle under your car because, well, it's not a mechanic's report. You still need to check it out. So the best answer is option B. Now, let's tie this to the exam task, performing procedures to validate the reliability of data and information. Reliability means completeness, accuracy, authenticity, and susceptibility to bias. Completeness. Did the data include all the transactions? Were dates and amounts recorded correctly? Authenticity. Did these transactions really happen, supported by source documents? Bias. Were they entered to meet year-end targets? Outputs, like visualizations, are not conclusions, they're prompts. The graph shows an unusual pattern, but the auditor has to agree information back to original sources, invoices, bills of lading, contracts. We also need to validate the query criteria used in the data analytics software. Did the software really pull all December transactions, or did it miss some because of a date format error? Professional skepticism and judgment. The spike could be legitimate, holiday sales, big contracts, or it could be premature revenue recognition. You can't know until you check. Standards, AUC 500 and PCAOB AS 1105, remind us that the reliability of audit evidence depends on its source and nature. A visualization is a red flag, not the finish line. So, in short, audit software is a flashlight. It shines a light on where to look, but it doesn't tell whether the food in the fridge is expired. You've still got to open the carton and smell the milk. And on exam day, if you see ignore the output or assume it's normal, that's code for this is the trap answer. Next question. An auditor is planning to use automated tools and techniques to handle a large data set of sales transactions. Which of the following statements correctly apply such tools to process, organize, structure, or present data so that it generates useful information for audit evidence? Let's evaluate each one. Statement 1. Process. Apply filters to isolate transactions in the last 5 business days of the year, ensuring data relevant to cutoff testing is analyzed. Yes, applying filters to focus on the last 5 business days is a valid use of automated tools to process data. This aligns directly with cutoff testing procedures. Statement 2. Organize. Group transactions by customer and product line, but only summarize totals rather than retaining transaction-level detail. Not quite. Grouping by customer and product line makes sense, but only summarizing totals instead of keeping transaction-level detail limits the usefulness of the evidence. For audit purposes, we need detail to test completeness, accuracy, and cutoff. Summarization alone isn't sufficient. Statement 3. Structure. Standardize inconsistent formats, such as converting dates and aligning invoice IDs, so data from different sources can be analyzed together. Yes, standardizing inconsistent formats is essential for structuring data. If you don't fix dates and invoice IDs, your analysis will fail. This is exactly what forming data attributes in the blueprint is about. Statement 4. Present. Use dashboards or exception reports to highlight unusual sales patterns, such as spikes and round dollar invoices at year-end. Yes, using dashboards and exception reports to highlight unusual trends is a proper way to present information from data analytics. This helps the auditor spot red flags like suspicious spikes. So, which statements are correct? Statements 1, 3, and 4. That makes the best answer option A. This fits the AI CPA representative task. Apply automated tools to process, organize, structure, or present data so it generates useful information for audit evidence. Process, filtering or extracting subsets of data to focus testing. Organize, proper grouping while retaining transaction-level detail, not just high-level summaries. Structure, cleaning and standardizing data attributes to make datasets usable. Present, visualizations and exception reports to direct auditor attention to anomalies. The point is, automated tools help turn messy, raw data into structured, reliable information. But if you skip transaction-level detail and jump straight to summaries, you might miss the very misstatements you're supposed to catch. So remember, filters, structure, dashboards, yes. Summaries without detail? That's like reviewing only the trailer of a movie and claiming you understood the entire plot.
Next question. An auditor applies data analytic techniques to year-end revenue transactions and generates several outputs. Which of the following demonstrate appropriate use of these outputs and the right audit response? Let's go through each one. Statement 1. A dashboard highlights an unusual spike in sales on December 31. The auditor investigates by vouching those transactions to shipping documents. Yes, this is the right response. A dashboard is a tool to highlight risk, but the auditor still needs to follow through with testing. Investigating December 31 sales by vouching to shipping documents is exactly how you connect analytic red flags to substantive audit evidence. Statement 2. A visualization shows stable monthly sales throughout the year. The auditor documents this as evidence that no further substantive testing of revenue is necessary. Nope, stable sales trends don't prove revenue is fairly stated.
Analytics can inform our risk assessment, but they don't eliminate the need for substantive procedures. This is like saying, the lake looks calm, so there must be no fish underneath. Wrong logic. Statement 3. An exception report flags duplicate invoice numbers. The auditor tests a sample of flagged items to assess whether misstatements exist. Yes, an exception report is valuable, but only if you actually test the flagged anomalies. Sampling duplicate invoices to check for misstatements is a proper, standards-aligned audit response. Statement 4. A trend analysis reveals that current year gross margin is significantly higher than industry averages. The auditor designs additional procedures to evaluate whether costs were understated. Yes, trend analysis showing gross margin way above industry averages could indicate aggressive revenue recognition or understated costs. Designing further procedures is exactly what professional skepticism demands. So the correct statements are 1, 3, and 4. That makes the right answer option A. This connects directly to the exam blueprint task: perform procedures to validate the reliability of data and respond appropriately to analytic outputs. Dashboards, exception reports, and trend analyses are useful, but they don't stand alone as audit evidence. The auditor must agree information to original sources, like invoices and shipping docs. They must test flagged exceptions instead of assuming their errors or dismissing them. They must design further procedures when analytics reveal unusual margins, spikes, or anomalies. The principle is clear. Data analytics highlight where to look, but the auditor still needs to gather sufficient, appropriate audit evidence through follow-up. So remember, analytics are like your GPS. They'll tell you where the traffic jam is, but they won't drive your car. You still need to hit the brakes, turn the wheel, and actually get to your destination. And on exam day, if you see an option that says analytics alone are enough to conclude no further testing is required, that's your trap answer. Treat it like free Wi-Fi in a sketchy cafe. Tempting, but don't trust it.